Hello friends, welcome to our today's session. Previous session we are talking about cost of debt and I had given you a kind of introduction to the subject cost of equity. Today we'll move to that area. Let us learn about the concept of cost of equity. Going to share my screen with you right now. Please wait for a minute. In the meantime, screen will be shared with you. Yeah, you can look at the screen, and by this time you are already aware of that capital of an entity consists of broadly two things. One is debt and second is equity. When you are talking of the debt has got a cost. Equity is also has a cost. And you are also aware of that cost of equity is higher or more than cost of debt. There are two reasons for that which we have talked in our previous class. You see, two reasons are there. First reason is that if you look at your screen, you can see first is the risk element. Risk element in the sense the equity shareholder takes more risk. More risk. If there is no profit, equity shareholder is not going to get anything. He's taking more risk. Whereas a debt holder will get interest even if there is no profit. So therefore, since equity shareholder is taking more risk, his expectation is more, and therefore cost of equity is more. Second reason why cost of equity is more is that cost of debt brings a kind of advantage that is called as tax shield. When interest is paid, profit is reduced, and it has got effect in reduction of tax, income tax. So that is the reduction of income tax is called as tax shield. So because of tax shield and because of the risk element, cost of equity is more than cost of debt. How cost of debt is computed? You know, it is basically interest, and if there is some other cost involved, average annual interest and annual other costs divided by average bond deployed. This is how we compute cost of debt. Cost of equity, how is the expectation of the shareholders? What they expect that becomes cost. This is an example of a share certificate. Shareholders get certificates like this. This is an entitlement that they are the shareholders. And unlike the debt, in case of equity, equity shares has got some typical features. First of all, dividends are not predetermined. In case of debt, you know beforehand, you are aware of that whether it is how much interest has to pay, whether 10%, 11%, 12%, but you don't know how much dividend you will get if you are an equity investor because it depends upon the profit. And in case of debt, there is a concept of repayment. Debt is taken, it has to be repaid, but equity need not be repaid. It will not be repaid. Equity is a permanent capital for the company. It is not paid back. And dividends are not tax deductible in the sense dividends are not treated as an expenditure. Dividends are reward to the owner. They are not expenditures. So for income tax purposes, they are not deductible expenditure. And dividends are given less priority over interest payment if profit is insufficient. First, interest will be paid because this is a due to the outsiders. After that, if some money is left, then dividend may be distributed. So these features also you have to keep in the mind. And one more principle also we had discussed in the previous case. Here on the screen, you can see a formula. It talks about P0 is equal to D1 by 1 plus R plus D2 by 1 plus R square plus D3 by 1 plus R cube up to Dn by 1 plus R to the power n. What it exactly shows, it shows P0 means price. Okay, P0 means what? P0 means price. It shows price of the equity shares as on today. So it says price of equity share depends on the dividend. So this D1, D2, D3 are the dividends in future year. For example, D1 means dividend at the end of year 1. That means suppose you are investing after 1 year, how much dividend you'll be getting, that is D1. D2 is dividend at the end of year 2. D3 is dividend at the end of year 3. D4 is the dividend at the end of year 4, like this. Since dividend equity is a permanent investment, so dividend will be paid like this till infinity. Okay, when I say D1 by 1 plus R, if you see, what is that we are doing? We are arriving at the present value of that dividend. That means, let us say 1 year, after 1 year, you'll be getting 20 rupees. But today's present value will be less than that. Today's present value, let us say it is 18 rupees. So that is, this concept is called as the discounting. That means the future value will be brought to the present value. This is called as discounting. So second year again, it is discounted at 1 plus R square. Third year, 1 plus R to the power cube square. R is the expected rate of return. So this shows the present value of dividend that you are going to receive after 1 year. This particular portion shows that D2 by 1 plus R square. This shows the present value of the dividend that you are going to get after 2 years. And this portion, if you look, it shows present value of dividend that you are going to receive at the end of 3 years. So like this, if you add up, you will be getting the present value of future dividends. Right? So this says P0 is equal to D1 by 1 plus R plus D2 by 1 plus R square plus D3 by 1 plus R cube, like this. This means that the price of the equity shares is the present value of future dividends. This is the concept I want to explain you before telling you anything about cost of equity. Are you getting me? The concept here is that price of equity share today, that is P0. P0 means 0 means today. 1 means at the end of 1 year. D1 means at the end of year 1. D means dividend. P means price. Okay, hope you have understood this formula. This concept only says that the price of the share today is the present value of future dividends. How to convert that future dividends to present value? That has to be discounted. Okay. So last class I had shared with you the discounting factor tables. You can refer to that tables, and using that you'll be able to discount the cash flows. Okay, friends. Okay. Now, after that, last class also I had shown you this thing, that how to compute cost of equity. There are various models. One is dividend valuation model. No growth in dividend. Growth in dividend, there might be two situations. And if there is no growth in dividend, cost of equity is very simple. D1 by P0, you can compute cost of equity. If there is growth in dividend, first one is constant growth. So formula you see D1 by P0 plus G, or step of growth by applying a trial and error method, we'll be able to compute it. Okay. Now, next is earning price approach. That is earning divided by market price plus G is the formula to compute cost of equity. One more formula is that realized yield approach. You can see at the screen. It is talking about dividend plus price appreciation divided by initial price. By using this formula, you'll be able to compute cost of equity. Then one more model called as the capital asset pricing model, CAPM. So that talks about a formula that is RF plus beta into RN minus RX. RF means risk rate of return. The formula is risk rate of return plus beta into market return minus risk rate of return. By using this formula, you'll be able to compute cost of equity. First case we'll see when there is no growth in dividend. That means we are talking about the situation when the dividend is constant. Okay, suppose you are invested 100 rupees in an equity share. Let us assume every year you are getting 20 rupees. Each year 20 rupees, 20, 20, 20, 20, 20, like this. If each year you are getting 20 rupees, that means there is no growth in dividend. So if you are seeing that situation, that there is no growth in dividend, then you can apply this particular formula to compute cost of equity. Okay, what is cost of equity? Look at this formula. Can anyone read this formula? KE is equal to, can anyone read this formula? Can you read it out? Just unmute and read it. Well, I can tell you what does it mean. KE is equal to D1 by P0. That means D1 means dividend at the end of year 1 divided by price today. By doing this, applying this formula, you'll be able to compute cost of equity. Very simple. Okay, that means dividend for equity share divided by market price. Okay, or net proceeds of per share. That means per share, how much money you'll be getting. That is similar to market price. Here is a question. Let us solve this question. Are you ready? Should we solve this question? Well, look at this question. A company issues 1,000 shares of 100 each at premium of rupees 10. Share value is how much? 100 rupees. Premium is rupees 10. That means it is issued at 110 rupees. 110 is the price at which it is issued. That is the market price. Company has been paying 20% dividend to the equity shareholders for the last 5 years and expects to maintain the same in the future year also. 20% dividend means 20% dividend will be paid on the face value. Face value of the shares is 100 rupees. 20% means each year dividend payment will be 20 only. Okay. Compute the cost of equity. Then there is one more bit to the question. Will it make any difference if the market price of equity shares is 160? So first let us compute cost of equity with this data. Then we will see that if market price is 160, then how to come, what will be the cost of equity. Right now, you know, the dividend payment is how much? 20% means 20 rupees. And price today is how much? 100 rupees plus premium 10 rupees, 110. So if you apply this formula, the KE is equal to D1 by P0. Okay, it comes to 20 by 110. If you want in percentage, then again multiply it with 100. It is coming 18.18%. Are you able to understand? Now, question is again asking if the market price of equity share is rupees 160, how to compute cost of equity? Friends, here dividend payment is same 20 rupees, but market price is 160. So if you apply the formula D1 by P0, it's 20 by 160. That's the answer. But if you want to express it in terms of percentage, then multiply it with 100. So 20 by 160 into 100, it becomes 12.5%. When market price was 110, the cost of equity was 18.18%. And when the market price is 160, the cost of equity is 12.5%. This gives us a lesson that at increasing of market price, cost of capital, cost of equity will decrease. Market price increases, cost of equity is decreased. Did you understand? Yes or no?
Yes, sir.
Okay, thank you. Okay, so in case you'll be having any query, then ask me freely. So formula here is very simple. Okay, formula is only D1 by P0. You have to remember. You have to calculate what is the dividend. Dividend is always paid on face value, not on market value. Here face value is 100. Dividend paid is 20%. So it is 20 rupees. Even if market price is 110 in one situation, or market price is 160 in another situation, but dividend is 20 rupees. So this is a very simple formula. I think you'll be able to answer this question. Okay. Right? Any query here?
No, sir.
Okay. Now, let us move to second situation. Situation 2. Situation 2, if you read, it is talking about the constant growing dividend. Here, dividend is growing constantly. Okay. In this case, it is behaves like a growing perpetuity. Perpetuity means it is continuing forever. Okay. And there is a formula for perpetuity. Time value of money concept. It, uh, if you learn, then you can understand perpetuity formula is like this. That is present value of a growing perpetuity is equal to perpetuity divided by time value of money minus growth. Okay. I have separate videos on the concept of time value of money. If you want, you can refer to those videos. It's available in my YouTube channel. You can see it, you can understand what is perpetuity, etc. This formula is derived, this formula of computation of cost of equity, you can say it is derived from that formula. Here you say, if you see the formula, it says P0. P0 is equal to D1 by KE minus G. Okay, that means price today is equal to future dividend divided by cost of equity minus growth. It is similar to the perpetuity formula which you have, which is uh, which you can learn if you want. So if this is the formula, P0 is equal to D1 by KE minus G. By using this formula, we'll find out what is KE. We're interested to know KE. That is, KE is the cost of equity. If you solve this equation, you can say or P0 multiplied with KE minus G is equal to D1 or KE minus G is equal to D1 by P0. Now you can get KE is equal to D1 by P0 plus G. Last formula, when there is no growth, you have understood that cost of equity is equal to D1 by P0. When growth is there, just add growth rate to that. So the formula here is that D1 by P0 plus G. Okay, I repeat, the formula is what? D1 by P0 plus G. Did you understand? D1 by P0 plus G. Okay, ବୁଝି ହେଉଛି? Right. Okay. This is another explanation to the formula. It says cost of equity is equal to DPS, that's dividend per share. Okay. Then MPPS plus rate of growth in dividends. Okay, so this is another formula. I'll be explaining you this formula. First, we'll solve that formula. Okay, that formula was that KE is equal to D1 by P0 plus G. We'll be understanding that thing. Okay, after that, we'll be coming in this thing. Dividend per share divided by market price plus share plus rate of growth in dividends. By doing this thing, also you can do it is something similar to D1 by P0. Okay, or net market price plus share plus growth in dividends. That is how we can come to. Okay. Now, here is a question. We'll be solving this question. Okay. Formula you have remembered. D1 by P0 plus G. Let us learn it. Here, this question says the company plans to issue 1,000 new equity shares of rupees 100 at par. At par means 100 rupees at issued at 100 rupees. The flotation costs are expected to be 5%. Flotation cost means when you are issuing the equity shares, there's a issue cost 5%. Company expect 5% issue cost means actually if you issue at 100 rupees, you'll be getting 95 rupees. So money you'll be getting at 95 rupees. Company expects to pay a dividend of 10 per share initially. Okay, expect dividend means D1, future dividend, is rupees 10 initially, and the growth in dividend is expected to be 5%. G is equal to 5%. Compute the cost of new issue of equity shares. This is the question for you. You know the formula D1 by P0 plus G. D1, you know what is D1? Future dividends is 10 rupees. P0, you know 100 rupees. Plus G is 5 rupees. G is 5%. You can apply this formula, but there is a catch in this question. Catch here is that you are issuing the shares at 100 rupees, but there is a protection cost of 5 rupees. So actually, you are getting how much? 95 rupees, not 100 rupees. So that is why this question is asked, because it's not that simple. Okay, so if you see the answer here, you see formula is okay, D1 by P0 plus G. What is D1? Is 10 divided by P0. P0 here, it is not 100. It is not 10 by 100 plus G is 5%. It's not like this. Because when I issue get 100 rupees, actually I'm getting 95 rupees, which is 5 rupees is the issue cost. That's why this question is asked, because there is a catch in the question. Market price is 100 rupees, but the net money you will be getting from the market is 95. So if you apply this formula, the D1 by P0 plus G, P0 has to be taken as 100 minus 5. Right? So it comes to plus 5%, it comes to 15.53%. Now there's another catch, another bit in the question. If the current market price of the equity shares is 150, then you can compute. If it is 150, you can find out again dividend is same, D1 by 150 plus 5%. It comes to 11.67%. That is how we will computing cost of equity. Hope you have understood up to this. Friends, I repeat once again that cost of equity is equal to D1 by P0. If there is any growth, then apply this formula D1 by P0 plus growth rate, that is growth percentage. You'll be able to compute cost of equity, sorry. So we'll stop here for a moment, but we are going to catch up after a short break of 10 minutes. Okay, so after 10 minutes again, we'll catch up. So take a break. Thank you.